All right, we're going to jump back in time to 1983 to unpack one of Warren Buffett's most important shareholder letters. Now, don't think of this as a history lesson. Think of it as the source code for his investment operating system, a really practical toolkit that's just as powerful for navigating the markets today. Buffett kicked off the letter with this quote from Keynes, and it just perfectly sets the stage for what we're doing here. This isn't about learning some new, complicated trick. It's about breaking free from the old, flawed, conventional thinking that gets so many investors into trouble. So, how are we going to do that? Well, we've built this entire analysis around three of the biggest, most fundamental problems that every single investor has to deal with. And for each one, we're going to break down Buffett's timeless solution, pulling it right from the source. Okay, first up is a classic, the agency problem. It's the core dilemma, right? You put your hard-earned capital into a company, but how in the world do you make sure the people at the top, the managers, are actually working for you? Buffett's answer is to completely reframe the entire relationship. He says, look, our attitude is one of partnership. He and Charlie Munger, they're the managing partners. And you, the shareholder, you're an owner partner. The key idea here is that the company itself is just a conduit. It's a legal shell, a vehicle that allows you to own the actual underlying assets. And here's the simple, powerful proof. They eat their own cooking. Back in '83, Buffett pointed out that for most of Berkshire's directors, more than half of their family's entire net worth was tied up in Berkshire stock. I mean, that's not just alignment. That's a shared destiny. Seriously, how many corporate boards can say that today? So how do you keep score? How do you know if your partners are doing a good job with your money? Buffett gives us this brilliantly simple metric, the dollar test. For every single dollar of profit that management decides to keep in the business, does it create at least $1 of market value for you? Think about it. If a company earns $10 a share and keeps it all, you better see the stock price go up by at least $10 over time. If it doesn't, that capital they kept is being wasted. It's a simple but absolutely ruthless yardstick. And finally, Buffett warns against what he calls gin rummy management. This constant impulse to discard your least promising business at every turn, like you're playing a card game. He's the first to admit that holding on to some mediocre businesses might drag down the overall numbers a bit, but he'd much rather do that than get caught up in hyperactive portfolio churning. It's a mindset that prioritizes long-term stability over short-term optimization. All right, on to problem number 2, the valuation problem. So you found good partners, but how do you figure out what the business they're running is truly worth? This is so important. Buffett draws a razor-sharp line in the sand right here. He says, book value? That's just an accounting number. It tells you what capital has been put in. Intrinsic value? The number that actually matters? That's an economic concept. It's an estimate of all the cash you can take out of the business from now until Judgment Day. And that distinction? It's the absolute bedrock of his entire valuation philosophy. And this leads us to one of his most powerful and maybe most misunderstood ideas: economic goodwill. Now, this is not that fuzzy line item on a balance sheet. No, this is the real, tangible value of a powerful brand, a patent, a competitive moat. It's the ability to earn spectacular returns on very little capital. It was key to understanding the great franchises back then, and it is absolutely essential for valuing today's asset-light tech giants. And there is no better example to make this crystal clear than his masterclass acquisition of See's Candies. This is where all that theory smacks right into practice. Just look at the numbers here. Berkshire pays $25 million, but the business only has $8 million in net tangible assets, factories, inventory, and so on. So accounting rules say, okay, that extra $17 million is goodwill, an intangible asset that you have to write down over time. But here's the magic trick. While that accounting number was literally shrinking on the books every year, the real economic power of the See's brand, its true economic goodwill, was actually growing like crazy. So that begs a crucial question, one that was incredibly relevant in the 80s and is just as relevant right now. What happens to a business like this, one that's rich in these invisible assets but light on physical ones, when inflation starts to run hot? This simple chart tells you everything you need to know. To double its earnings and just keep up with inflation, a boring asset-heavy business would have to dump another $18 million in capital back into itself. But See's, because its real value is in the brand, not the buildings, it only needed $8 million to get the same result. It required way, way less capital to maintain its real earning power. And that leads to this absolute gem of a line from Buffett, that true economic goodwill It's not just an asset. In an inflationary world, it is an absolutely magnificent one. It really is the gift that just keeps on giving. Which brings us to our final big challenge, problem number 3, the investor problem. Okay, you've done the work. You've found a great business with great partners. Now, how do you survive the manic, casino-like behavior of the stock market itself? Buffett's strategy here is totally fascinating. It's not about trying to time the market or predict its swings. It's about trying to curate the market for his own stock. He actively works to attract long-term thinkers who see themselves as business owners, and he just as actively tries to push away the short-term speculators. And here's why. It's one of his all-time greatest lines. If you attract a bunch of emotional manic-depressive people to own your stock, you're going to get an emotional manic-depressive stock price. It's that simple. By communicating clearly about business value and famously refusing to split the stock, he lets investors self-select. The patient ones stay, the gamblers go elsewhere. Now, this idea just flies in the face of everything Wall Street preaches, doesn't it? They're obsessed with liquidity and activity. Buffett argues that high turnover isn't some great virtue. It's a tax, it's a frictional cost that does nothing but bleed value away from the actual owners of the business. And he drives the point home with this unforgettable image. A hyperactive stock market is the pickpocket of enterprise. All that frantic trading only makes the house, the croupier, richer, while it literally takes money out of the pockets of the real owners. So how much are we talking about here? What's the price tag for all this activity? Well, back in 1983, Buffett estimated that this self-inflicted chair-changing tax was costing investors an incredible $7.5 billion per year. And to put that number into a context you can really feel, that was about the same as the entire combined profits of the 4 largest companies in America at the time. All the value created by these absolute giants of industry was basically vaporized by the cost of investors just trading pieces of paper back and forth. It's a truly staggering thought. And that brings us to the end. These principles were laid out decades ago, but they have never felt more relevant. So I'll leave you with a question to think about. In today's market, which is faster and more frantic than Buffett probably ever could have imagined, which of these core ideas is the most powerful tool for your survival? And which one do you think is the most ignored?